Good day and welcome to Academic Bulletin. Today, Monday 1 June, we will be discussing an important topic related to a country's economic system, which is individual income tax. In general, income tax is a tax imposed by the government on the income earned by individuals and businesses. This income may come from salaries, business profit, investment, and other sources of earnings. Individuals that meet certain income requirements are required to declare their income to the tax authorities. Failure to comply with tax regulation may result in penalties or fines. In addition, taxation systems differ from one country to another. For example, Australia applies a progressive tax system where higher income earners are charged higher tax rates. Meanwhile, Singapore is known for having lower tax rates and a simpler taxation system. Taxation can also be divided into two main categories, which are direct tax and indirect tax. Direct tax is imposed directly on an individual's or business's income, where indirect tax is charged on goods and services purchased by consumers. Besides tax classification, taxation system can also be explained through several important elements, such as tax base, tax rate structure, and tax technique. Firstly, tax base refers to the source or amount that is subject to taxation. This may include income, property, sales, or business profits, depending on the type of tax imposed. Secondly, tax rate structure refers to the way tax rates are applied. For example, under a progressive tax system, individuals with higher income are required to pay higher tax rate compared to lower income earners. Lastly, tax technique refers to the method used by the government to collect tax from taxpayers. This may include systems such as direct payment, tax deduction from salaries, or electronic tax filing. All these elements are important in ensuring that the taxation system function effectively and contributes to the country's economic development. So, to gain a deeper understanding of taxation principles and their implication on society and the economy, let us move on to the next section titled Taxation Principle and Implication.
Alright, thank you Fatis. So I'm Wahida. Now let's move on to the taxation principles applied in Singapore and Australia. Our report found that both countries apply two important taxation principles, namely the principle of equity and the principle of efficiency. Firstly, the principle of equity focuses on fairness in taxation. Under this principle, taxpayers contribute according to their ability to pay. So as shown here, equity consists of horizontal equity, where individuals with similar incomes pay similar amounts of tax, and vertical equity, where higher income earners contribute more tax than lower income earners. Looking at Singapore, the country's progressive income tax system reflects this principle. Tax rates increase gradually from 0% to 24%, ensuring the individual with higher income contribute a larger share of tax revenue, while lower income groups face a lighter tax burden. Meanwhile, Australia adopts a more progressive tax structure with the highest marginal tax rate reaching 45%. This means higher income earners contribute proportionately more taxes. As a result, Australia achieves strong income redistribution and lower income inequality compared to Singapore. Based on our comparison, both countries apply the ability to pay principle. However, Australia places greater emphasis on redistribution, whereas Singapore focuses on balancing fairness with economic competitiveness. Moving on the principle of efficiency, this principle aims to ensure that tax revenue is collected effectively while minimizing administrative and compliance costs for both taxpayers and governments. In Singapore, efficiency is enhanced through digital platforms such as My Tax Portal, SingPass, and the Auto Inclusion Scheme. This system simplifies tax filing, reduce paperwork, and improve convenience for taxpayers. Similarly, Australia improved efficiency through digital systems such as MyGov and MyTax. This platform provides pre-filled tax information, improve reporting accuracy, and strengthen tax compliance. Overall, our findings indicate that both countries successfully apply the principle of efficiency through digital tax administration. However, Singapore places greater emphasis on convenience and simplified filing procedure, whilst Australia focuses more on compliance and administrative efficiency. So that's all for the taxation principle section. Back to the next presenter.
Now, we move to the inflation of tax revenue in Australia and Singapore based on the government revenue, economic conditions, social welfare, and various stakeholders. Australia applies a progressive income tax system with the highest tax rate of 45% for high-income earners. Income tax is the largest source of government revenue and helps maintain financial stability. In 2023 to 2024, Australia collected 801.7 billion Australian dollars in taxes. The revenue is used to support Medicare, public education, infrastructure projects, unemployment relief, pension schemes, and welfare assistance, as well as 81.1 billion Australian dollar will be spent on schooling in 2025. Singapore applies a lower personal income tax system with a maximum rate of 24%. In 2024-2025, Singapore received 88.9 billion Singapore dollar in tax revenue, while its operating income in fiscal year 2023 reached 104.3 billion Singapore dollar. The revenue supports healthcare subsidies, Medishield Life, education, MRT infrastructure, transport development, and comcare assistance. Singapore also used tax revenue to support skills teachers program for lifelong learning. Income tax also affect economic conditions. In Australia, higher taxes provide more funds for public infrastructure, healthcare research, technology, and quality education. Government spending in 2023 represents about 24% of Australia's GDP, helping productivity and economic growth. However, high tax may reduce disposable income within consumer spending and discourage investment activities. In Singapore, lower tax rates improve business competitiveness, attract foreign investment, create employment opportunities, and encourage consumer spending. However, lower tax revenue may limit government investment during economic recession and increase dependence on GST in future. Income tax also affects social welfare. Australia's progressive tax system will reduce income inequality through welfare payments, pensions, Medicare, childcare support, and financial assistance schemes. However, higher tax rates may reduce household disposable income and affect living standards. In Singapore, lower income tax allows people to keep more income and improve their quality of life. Tax revenue supports education, scholarship, affordable housing, comcare, and welfare programs for senior citizens and disabled groups. However, income inequality remains a challenge compared to Australia. Turning to the impact on various stakeholders, income tax affects the government, individuals, education sectors, business, and investors. In Australia, tax revenue helps the government provide Medicare, education, welfare assistance, and infrastructure development. In Singapore, tax revenue support public service and national development despite lower tax rates. For individuals and households, Australians receive benefits such as pensions and financial assistance, while Singapore enjoy high disposable income because of a lower income tax rate. Income tax also support education and human capital development. Australia subsidies university education while Singapore invests in education and skills future programs to improve workforce skills. For business and investors, Australia invests tax revenue into technology and infrastructure, although higher tax may increase operating costs. Meanwhile, Singapore's low tax system that attract multinational companies and foreign investors by reduced business expenses and increases investor confidence. So, Australia focused on higher income tax to strengthen public service and social welfare, while Singapore emphasized lower taxation to support economic growth and investment.
Assalamualaikum and hello everyone. Welcome back to our news segment. I'm Najwa Awatib binti Abdul Rashid and metric number is 305949, and today I will explain the comparison between tax avoidance and tax evasions. First, tax avoidance refers to a legal way used by individuals or companies to reduce the amount of tax they need to pay. This method follows the law and use strategies such as tax deduction, tax credits, and proper tax planning. For example, businesses may claim allowable expenses to reduce taxable income. Therefore, tax avoidance is considered legal because it complies with government tax regulation. On the other hand, tax evasion is an illegal act of avoiding tax payment. It happens when individuals or companies hide income, provide false information, or fail to report their actual earnings to tax authorities. Unlike tax avoidance, tax evasion breaks the law and can lead to serious penalties such as fine or imprisonment. So, there are four main differences between tax avoidance and tax evasion. The first aspect is legality, where tax avoidance is legal, while tax evasion is illegal. The second aspect is myth. Tax avoidance avoidance use proper tax planning and incentive, whereas tax evasion involves fraud or concealment. The tax aspect is purpose. Tax avoidance aims to reduce tax legally, while tax evasion aims to avoid paying tax illegally. Lastly, in terms of consequences, tax avoidance does not result in criminal punishment, but tax evasion may lead to fine or imprisonment. So in conclusion, although both involve reducing tax payment, tax avoidance is accepted under the law, while tax evasion is considered a criminal offense. Therefore, taxpayers should always follow legal method in managing their tax responsibility. That's all from me. Thank you.
Good day everyone and welcome back to Tax News. For the final news for today, I'll be covering the comparison between Australia and Singapore regarding income tax avoidance, tax evasions and their enforcement systems. Now, let's start with Australia. In Australia, income tax avoidance is considered a major issue, especially among high-income earners and multinational corporations. Many companies use legal tax planning strategies to reduce their taxable income, while some individuals illegally underreport their income to avoid paying taxes. As a result, Australia faces what is known as a tax gap, which means the government collects less revenue than expected. And what happens when government revenue decreases? Well, public service may be affected. Lower tax collection can put pressure on healthcare services, infrastructure projects, welfare assistance, and even education programs. In simple terms, less tax revenue may mean less funding for public needs. Now let's move to Singapore. Compared to Australia, Singapore has lower levels of income tax avoidance and evasions. This is mainly because Singapore has a simpler tax system, lower income tax rates, and strong monitoring system that encourage taxpayers to follow these rules. Because of this, Singapore is able to maintain stable and predictable government revenue. This stable revenue support efficient public services such as public housing programs, healthcare subsidies, modern transport systems, and community development projects. It is contributing to a high standard of living for its citizens. Next, let's look at the enforcement and compliance. In Australia, tax administration is managed by the Australian Taxation Office or ATO. They use tax audits, data machine technology, and online income tracking system to detect tax evasions. Meanwhile, Singapore, IRAS, the Inland Revenue Authority of Singapore, uses a highly digitalized system with automated reporting and strict penalties, resulting in higher taxpayer compliance. Overall, while both countries have strong tax systems, Singapore appears to have stronger compliance and more stable revenue collection compared to Australia. And that's all from me for today's Tax News. Thank you for watching.